Hi there.
Hello.
Hey,
How are you?
Good. Thank you so much for doing this and
Hey, no
getting.
problem. This is actually part of my passion. So, I usually work with adults, but because of what this does for kids and all that good stuff, I'm very passionate about this. And so it's an honor and it's a pleasure to do this as well. How's everything going with you?
Good. Just living through a pandemic with an
Uh,
8 month old, you know.
here we are. Here we all are on Zoom, right? And I mean, there's a whole lot more to say beyond that.
Right.
But I understand you have a child, or
Yes, I have an 8 month old. So basically, he was born just a few weeks before all this went down. So, yeah,
just
I
born into one heck of a world, that's for sure.
know exactly.
There's so many things that I really don't think about, but I'm going to introduce you to my grandson. I have my grandson that today turned
Oh,
14 days old, and
oh
so
my goodness.
like
Congrats.
I was like, man, if this guy only knew what he was born into,
Right.
'cause I didn't think it was going to be going on this far. I
Yeah,
thought
I
it was
know.
summer.
Nobody did, I think. I mean, I don't
Yes,
know. At least none of us.
exactly.
I'll be very honest with that. Honestly, I didn't see it lasting this long, and just with what's going on in here and in Europe, especially, with the second wave, and I mean, it's coming to a theater near you, meaning a city near you, and so I don't know. I really don't know. We work with a lot of specialized markets, and all of them just shut down the way we used to do business because of that. Teachers is our biggest market, and police departments as well, doctors and nurses, and everything got shut down the way it used to do business. Just, I mean, unbelievable. And I think that just today here in California, where are you? I'm sorry. What city are
I'm
you?
I'm in California, so
Oh,
I
okay.
I'm in Marin, the other side of the Golden Gate Bridge. Yeah.
Oh, okay. Okay. Exactly. That's a beautiful part of town.
Yeah, it's pretty
I've
nice.
been there a few times. A few
Yeah,
times. Really nice,
very
but very nice.
very green, except
Nice.
so we're in the hills, and the other night we did an outdoor kind of movie night, social distance with another couple. And all of a sudden we look up and we see, I want to say, six sets of beady eyes. And it was basically a pack of raccoons. And we're like,
Oh, Lord.
we're like, are we
Wow.
gonna be okay? They didn't bother us, but they were just like, it was a stare down for like five
That's,
minutes.
wow. Yeah, that's a beautiful part of town. I was there I was there a few years ago just doing the whole tourist thing with some family members that came over, but I was stationed back in the early 90s. There's a place called Mincy, Mare Island Naval Shipyard. Uh,
Oh wow. Yeah.
Also Concord. There used to be
Yeah.
the Naval Weapons Station. I was also at the other place at Mincy, is right outside of Vallejo. Uh,
Okay. Yeah.
so yeah, a lot of these places shut down already. That was
Yeah.
a long time ago. But wow. Okay. Well, I'm not going to take much of your time.
Okay.
I thank you for your time, and like I said, my only intention here is to share with you kind of what Sonia's so excited about. That also has myself, to be honest, excited about. And I've been doing this for a while. This is actually technically my 13th year with this company, and the reason, like I said, that I get so passionate about it is because of the fact that while this is not the thing that makes us our income, it's adult policies. The concept that I'm going to share with you is really intended primarily for adults. But what happened many years ago, they started to apply this with children because they have nothing but time. And amazing what has been happening. And I'll give you a few examples regarding this myself here in just 1 second. So, like I said, my name is Javier Rodriguez. Been with this company 13 years. The company I'm going to talk to you about has been around a little longer. It's been around since 1848. Over 930,000 clients nationwide right now. It's a mutually held company. So, what that means is that when somebody gets approved with this company, there are no stockholders. It's a multi billion-dollar company, but it's owned entirely by the policyholders. And so that's what's called a mutually held company versus one that's publicly traded. This is not publicly traded. And so that's how, since 1848, they've been able to keep their financial promises they made and continue to do so to this day. I don't know if you were told of this or not, but just as a way of saying thank you, we're going to give you a vacation or a stay, I
Oh.
should say, in Vegas for 4 days, 3 nights, and it's pretty cool. We send hundreds and hundreds of people to Vegas as part of this program. The way it works is you're responsible for two things, which are transportation to and from there. Thankfully for us, we drive up there. And then the second thing is you are responsible for taxes, which are around $22 a night, and you have 2 years to travel because right now a lot of people don't want to travel.
Right.
My wife and I semi-retired, and so we usually just travel every 2 months somewhere on Earth just to get away. We haven't gone anywhere since we
Yeah.
came back from Bali in February for Valentine's Day. I took her there for Valentine's Day, and when we got there, there was only 15% occupancy in the entire resort,
Oh,
and
no.
so we knew something was up when no, everybody scattered, and so as soon as we landed back here home, that's when the whole mess started,
Yeah.
and it's been crazy, crazy since then. But like I said, so just for being here tonight, you're going to get this certificate. You've got 2 years to travel. So if you don't want to travel right now or anytime soon, you've got 2 years. You do have 7 days to redeem it, meaning you do have to pay the taxes on it right now for the 4 days, 3 nights. Most of the bookings we've seen in the last couple of days have been MGM Luxor and Treasure Island. So those are the ones that have been kind of trending right now. But based on when you want to go, it's really what shows what's available on those days. And so, so if you don't redeem it within the next 7 days, just reach out to me in the future, and I'll send you a new certificate. And don't worry about that right now, because a lot of people tell me I'm really not thinking too much about travel, or a lot of people are itching to get out of town too. So it goes both ways. And so I'm going to go ahead and just share that with you as well. Like I said, usually what I do is I give this presentation to groups of people in what we call specialized markets: teachers, police officers, and nurses, doctors. We do a lot of what I call staff meetings. I do a lot of what I call roll call presentations for the officers before they start their shift. And so this is something that's been around, like I said, for a very, very long time. Unfortunately, most people don't even know this exists. And so for me, it's a true passion to do this in a group setting because it's so in such an effective way to deliver the message. But since pandemic, well, Zoom is just as convenient because I don't have to dress up and go out at 3:30 in the morning to catch these guys before they hit the field and all that stuff. So the presentation is called the $1 Million Baby Concept. And so what we have done with this concept is taken what works so well for adults and applied it to children. And because of the fact that children have so much time, it gives this program money for the time for the money to compound multiple times over, not to mention some of the other benefits as well. So the two questions I ask when I do this in front of teachers for their kids and parents, because we used to do these in hotels and just your typical seminars, we would always start by asking, what kind of a life do you dream of for your baby? And most people would say, well, obviously a good life, blah, blah, blah. But then the second question is, what kind of a financial life do you dream of for your baby? And then that's when we would start to get into very specific things, such as college. Man, if I could help them do this, if I can help them do that. And it's very, very true. And it's all doable if you understand the concepts that are out there. And as you know, nothing represents a new beginning more than the birth of a child. This is why we all love these babies. And so the birth of a child would provide you, the parent or grandparent, in some cases, the opportunity to build and pass on a legacy that will continue long after we're all gone. This legacy includes our values, work ethic, culture, heritage, religion, and so much more. But there's another legacy you can leave that can bring many benefits and advantages to a child as well as future generations. And that's a financial legacy. And that's what we're going to talk about here today, how simple it can be to do just that. Because with proper planning today, you can provide your child a life full of financial security and stability. And specifically what we're talking about is giving your child the ability to, let's just say, go to college and not have to worry about breaking the bank. College is expensive. And on top of that, if we don't have the amount of money or any money saved up, we end up burdening them with debt, student loan debt, and so on. The concepts I'm going to share with you are concepts I've used with my own children. I'm an old man. I'm a grandfather. My, like I said, the oldest one is 30. My middle one is 25, and my youngest is 21. And the two oldest ones have babies. And so I'll introduce you to them here in just one second. But for me, I did this with my own kids, and it helped me push my middle daughter through the RN program. She's a registered nurse now. And the good news is zero debt as far as student loan debt was concerned, because we leverage what I'm sharing with you here today. So I'm not pitching you something I don't have on my own life. And I do this, like I said, out of passion. Another thing that we help parents do is help their kids buy their first home. I mean, it is so hard for us to get into homes nowadays, let alone for the younger generation, that it's very difficult for them to really buy their first home. And once the money starts to grow, unless somebody touches it or you decide you want to leverage it all for one specific goal, you can literally help them with the second home, retirement. I mean, there's so many things you can do with money when you have it. When you don't have money, well, that's the problem. The number one product I'm going to share with you here today is something called an Index Universal Life, or IUL, and it's a permanent form of life insurance. It's different from other types of insurances that people have, where you only pay for a certain amount of time, and then when you stop paying, it expires. Most people have not life insurance, but death insurance, because they have to die in order for that puppy to pay out. Well, where this program does not. You can literally use this life insurance while you're still alive. In case of an illness, in case of an accident, in case of many other things, you can tap into your life insurance. And this is where it gets a little confusing for parents, because they're saying, why life insurance? I mean, what does life insurance have to do with college, your first home? And it's not that it's life insurance. The life insurance portion is just an added bonus, because what we really want are the benefits that life insurance savings plans offer consumers, including tax-free growth, the use of funds for tax-free. You can open a plan for your kid as early as 14 days. My grandson, as a matter of fact, tomorrow's a big day. He turns 14 today. So tomorrow, he's 15 days. We're submitting his application to get one of these plans for him. I'm opening up one myself, and my daughter and her fiance are opening up one for him as well. So he's going to have a dual engine powered savings plan that's going to benefit him as well. And here's the best part. The savings that you save in these things is called cash value. It can be used by your child for any financial need in life, including obviously education, down payment on a home, starting a business, even to provide financial security for their future family. And that's the beauty of it. It provides steady, predictable growth. And it could be opened up by anybody that has what's called an insurable interest. It could be an uncle, an aunt, a parent, a grandparent, and so on. And the nice thing about this is that you're going to own it forever unless you turn it over to your child. The youngest they can be before you do that is 18 years of age. So if you really wanted to just hand the whole plan over, you could do that. Or doesn't matter how old they are, you will remain the owner until they're 20, 30, 40, until you sign it over for them. So whenever you feel they're financially responsible, you sign it over to them as well. It does count as an asset when you need it for purposes of buying a home and many other things. But the flip side, it doesn't count as an asset when it comes to financial aid, scholarship, FAFSA, and other programs that if you have money in the bank and you're applying for financial aid, well, they're going to say, we're not going to approve you because your parents have money. Whereas here, it does not count against them. And I can tell you that from experience, but my kids were in college, it did not count against them, which is pretty cool. So let me just share a story, and I'm going to wrap it up here real quick. This is actually my grandson. This is actually when he was on vacation in his mom's tummy, I guess. And as you notice, the date, that's from September the 8th of this year. And so the same thing that I believe in is what I started to do for him. And it's ballpark kind of like with your child as well, because it's the same age, if you would. And so what I decided to do here is save $100 a month for him, $100. So if you look at here, $100 a month equates to $1,200 a year. That's the annual sum. And so $1,200. And so the way I do it with with him, I'm just going to pay annually. You can pay monthly, of course, quarterly, semi-annual. I just write one check for $1,200, and I don't want to deal with it. So $1,200 goes in there. And because children under 14 are approved automatically, immediately he has a face amount life insurance of almost $400,000, $393,000. Now, the obvious is, if God forbid he passes, there is a death benefit that's going to be paid out income tax free, but we're not doing it for that reason. Like I said, that's just the added bonus. The real reason is that in case he does, God forbid, come down with some kind of critical, chronic, or terminal illness, then this life insurance can be advanced to hopefully get him better. We have a client that not recently, it's been like 7 years now, opened one up for her granddaughter, and the granddaughter, just 4 months into the plan, developed leukemia, which is a form of cancer of the blood. And so what ended up happening, we put in a claim. They ended up advancing the mom $75,000 that she could use to stay home, because she's a single mom. She couldn't miss work because she needed the income. So what she did is she just took a leave from work, focused on her daughter, and eventually the daughter beat the leukemia. And so she just has to be cancer-free for 10 years total, and then we can open up another one for her. But the nice thing about it is mom had only paid $50 a month for 4 months, which is $200. Yet she got $75,000 income tax-free. She never has to pay back. And so that's a side bonus, because we're not doing it for that reason. This is the reason that we're doing it. If you notice, at the age 18, in this example, my grandson will have $25,996 saved up, almost $26,000. Let's just call it $26,000. that can be used to pay for or offset the expenses of college or any kind of higher education or anything else. In California, we have what's called Scholarshare, which is a 529 plan, which is better than nothing. The challenge of that is that it can only be used for educational expenses that are approved by the state. So if the child goes to a school that's not approved or needs it for stuff that's not related to education, then the whole thing is taxable to the parents or whoever owns the plan. This is income tax-free money that can be used for anything. Now, we talk about college a lot because it's important, but it could be used to buy a car. It could be used for a vacation. It could be used for textbooks. It could be literally used for anything. Now, what I love about the life insurance portion here is that when people hear insurance, they think of things like, let's just say, car insurance. Let's just say you pay $200 a month in car insurance. Well, that's $2,400 a year. And let's just say for 10 years you don't crash, you don't put in a claim, that's $24,000 you gave them. And even though you've never put in a claim, you never crashed or whatever, they keep the whole thing. I mean, we literally just lose it. This plan doesn't work this way. Every dollar you put into this plan, part of it goes towards the savings plan. And then that savings portion grows based on the performance of the S&P 500. It doesn't go in the S&P. It's just mirroring what the S&P does. So if the S&P goes up, your balance goes up. If the S&P goes down, you level off. You don't make any money during that period, but most importantly, you don't lose any money. So you can only go up, you never go down, you only move forward, and you never have to worry about moving back. And so let me just fast forward here just a little bit to show you a little bit more. Let's just say my grandson's 25 and needs a little bit of help with down payment or buying a home or what have you. Well, in this example, by that point, he's got $47,000 in there that can be used at any time for any reason without penalties or taxes. If we wait till he's 30, well, then at that point, he's got $70,000. And of course, from there, it just continues at 45, he's got $204,000. And so that's based on what's called a projection, that we actually use a lower interest rate that we are allowed to use because we don't want to paint some pie in the sky. But this is actually what the programs do. So I want to introduce you to somebody else real quick here. And it's this person right here. And this is my granddaughter. Now, my granddaughter is 3 years old. And so the same thing, when she turned 14 days, the day after she turned 14 days old, I opened up one for her as well. And so I'm actually going to show you the app that if you were to have this program, you would have on your smartphone. And right here, you see two different accounts. The top one is one of mine because I have a few of these myself. And I have one for $250,000. I put in, I'll show it to you in just 1 second. But the bottom one is my granddaughter. That's what I want to share with you. And as you can see here, she's 3 right now. So that means I've on her birthday, I send in $1,200. And so even though I've sent in 3 $1,200 payments, you see where it says on the bottom, it says total premium paid. I've sent in $3,600. But because she just turned 3 this past July, it's really only had 2 years of money to grow. The last one just came in this past July and it's doing good, but I have given them $3,600. Now, out of the $3,600 that you see there, if you just scroll up to the top where it says accumulated value of the $3,600, I have $2,500 of it in savings for her already. So that means that the difference between the two, which is about $1,000, it's what it's cost me for the insurance over the last 3 years. And so in about 6 years, because they're so young, like your baby, and because they have nothing but time, it's just a matter of time before the balance is a lot more than what they put in. If I start one for me at my age or whatever, I don't have as much time as them. So it's not going to really double or triple the way it does for children so quickly because they have nothing but time. The risk of them passing away is almost zero. So the insurance is almost free. There's just no risk. But it is a life insurance program that allows you to achieve the tax-free growth, tax-deferred growth, and tax-free access at the end. That the only thing that really does something like this is a Roth. But the problem with Roth products is they're only worth whatever you have in your account. So if I had this in a Roth or a 529 plan, I technically have $2,500. But if she comes down with an illness, especially something serious, I don't tap into the $2,500. I tap into the almost 400 of the 325,000, which is just simply incredible. There's nothing else out there that affords us that. And so again, it's really nice because when the day arrives, and I'm going to actually fire up my phone. Let me just go ahead and show you this real quick. I'm going to go in here. Where do you go? Okay, here it is. So what I'm going to do is I'm going to just pop up, just switch the share, and I'm going to share now my iPhone, and I'm going to, okay, there we go. And this is in real time because I just want to show you the power behind this. And so let's see, it's going to open up in just 1 second. Hopefully. Oh, there it is. So what I'm going to do is, there it is, for clients. This is the same thing all of our clients get. I don't get a different program because I represent this company. I get the same thing. So tomorrow when I apply for my grandson, I get the same thing you would get, your child would get. And so that's the same numbers that I've seen, that I showed you earlier. But see, the top number has already grown since the last time I took a screenshot. So I'm going to tap. I'm gonna tap into mine. And what's nice about this is that when you need money for whatever reason, all you do at the top, I'm gonna tap on the loan tab, and it shows how much is available for withdrawal or for a loan. Now the minimum is $500, but I can, let's just say I need 5,000. I just go in here, tap on the request funds, the amount that fits between 500 and 14,000, and in 2 days max, it goes backwards from where the money was being drafted every month as well. So whether it be college, and again, it doesn't, we say college and we should think college, but maybe it's, all my kids ended up taking, the trips to Washington, D.C. when they were seniors. And just stuff like that they charge you like 10 times more than the thing costs it because that's just the way they do it. But it's better to have the money. It's better to have the money and not need it than need it and not have it. And like I said, if you happen to have the money because other funds you have around you, well, this just continues to grow and eventually become a legacy that goes beyond you and I as well. And so that's why I'm saying these are the things I have in my life. These are the things that, in going back to my granddaughters, which is hers coming up right now, you download this on your phone. You just go to transactions, and you can literally follow in real time. 1440 that was earned in interest, 29 that was in interest, 392 that was in interest, plus the $1,200 I've been doing for 3 years. So as you can see it, you can track it in real time because it's based on the performance of the S&P 500. It does have a cap of 14%. So if the S&P goes up 10, your account gets 10%. But if the S&P goes up to 20, it's been doing great. We're in a bull market right now. It does cap off as 13 to 14%, depending on the product and the company, because we do offer other ones as well. And so, like I was saying, in a nutshell, and let me just go back over here. Here it is. Okay. And so, like I was saying, in a nutshell, this whole plan is something that, combined with the most precious commodity your child has, of course, today, which is time, we can definitely leverage it and give them the financial security, peace of mind that we want to, or we can just simply let it slip away. One of the things that's very unique about this is that probably half of the policies that I open up for kids end up being financed by a grandparent most of the time, where they want to pitch in as well. You can do that. So you could say, I want to put this much per month, and you can actually lower it if you have to, but you can also increase it to a certain limit, of course, based on the IRS regulations. And that's why I'm saying that your child's financial life and your legacy will be determined in great part by the decisions and actions you take on their behalf today, because obviously they can't choose for themselves. And so the reason that I'm passionate about this, like I said, is because it really does allow us, and I say us because I really do believe in making our community as humans, if you would, better for our children, because things are tough and they're getting tougher, especially for the younger generation. It's not enough for us to say that, well, I'm doing okay. I want my grandkids, not that my kids are doing okay, I want my grandchildren to do as well. And it's something that, again, is permanent, meaning it stays with them for the rest of their life. And so, what we can do is we can, at your leisure, just run some numbers for your own child. Now, this is a private webinar. We usually have more people on it. I just finished one a little earlier. And so I always tell them I can't run numbers for you because I don't want to do that. We can do that privately. But if you're interested, I can give you a snapshot right now of what it could look like if you're interested, just to see what this could do. Or we could do it in a more private setting by just you and I being on a webinar. It's up to you.
Yeah, I was thinking maybe even adding my husband too for the time that we're.
Sure. And if you want to, we could schedule a webinar where he's on it.
Mhm.
I can run it for you guys because I'm telling you, the reason I get so passionate about this is because if not for these concepts, my kids would not be where they are right now as young adults, and my grandkids are well on their way. Today earlier, there were actually one of them is spending the night. My granddaughter spending the night with us here tonight, but my grandson was visiting, all 14 days old of him. But like I said, so we're just kind of going in circles waiting for tomorrow because tomorrow's the day he gets his.
Yeah.
And like I said, if the parents want to open up their own, which I hope they do, they do. They are wonderful, but I'm not going to take a chance on my grandkids. And I always tell my kids, don't take a chance on your children because it's amazing how much money we blow on them, anyways. I mean, it really is amazing how we don't even think twice, and yet we're spending a lot of money. And so I'm not saying to do that. You know, I've always told people that the dumbest, stupidest thing you could do as far as home improvements, I always tell people, stay away from pools, swimming pools. You're never going to get your money back, whatever. And my granddaughter said, she called me, Chachi, I really want a pool. Okay, here we go. And they just finished it last week. She was actually in the pool right now. That's why she's here. And so I always tell people, I just spent $50,000 on a pool just for her. So it's crazy thing that our grandkids will make us do, but it was worth it. It's really, definitely worth it. But we spend the money. What if we just set something up that we know no matter how everything turns out, there will be something there for them that will definitely outlive them. And the way I have it set up with my kids, these are tied to my other life insurance policies that if something were to happen to me, what's nice about this, you can fund it. And I don't know if you saw it, but you can fund it like in this example. This is, and I'm just assuming that this is you paying $100 a month until they turn, let's just say 18. You could just simply tell them, look, I'll keep paying until you're 22. And once you get your job or your career, take over the $100, and you can do that. The way I'm doing it is I'm actually going to pre-fund it. So I'm putting $100 a month right now for the first 3 years. Then I'm going to bump it up a little bit more. And by the time that my granddaughter and my grandson are 16, nobody has to pay ever again. And it's funded for the rest of their life. You can do that, which is pretty cool, and not take a chance. And so,
And how is this different from, for example, my father just wrote me a check for my son for something like this, and we've been putting it off. Originally, I was going to go to, our local Chase Bank and open up there. So how is this different than working with a big bank like Chase?
Sure. A couple of different things. When you go to a bank, differences are, let's just say you open up a savings account. Perfect example. The downside with savings account is that they literally pay us less than 1% a year. Less than 1%. So you're going to end up with the bulk of the money in there is going to be what you put in. Meaning that plus a little interest. I mean, 1% doesn't go a long way. There's a thing called the rule of 72. So the rule of 72 goes as follows, and I'll show you how powerful this is. Now, hopefully you can see it on the screen. I don't know if you can see my phone, kind of. And so let me see if I can open up my calculator. And so what the rule of 72 tells us, because the question you need to know is whether it's us or anybody else, how often will my kids' money double, my balance? How long will it double? Because if it's not doubling too often, then you might as well put it under the mattress, that kind of a thing. Not only do they not pay us the whole 1%, but let's just call it 1%. You have to pay taxes on that gain of a whopping 1% every single year. The bank's going to send you a little slip, you hand your tax person, and they're going to look at it and say, woohoo, you weighed $40 this year, right? Even though it's not a lot, you're going to pay interest. This one, the interest that's compounding on the account, you don't pay a penny while it's compounding, nothing. It's what's called tax deferred. And it's just like and so that's why I was saying that it's pretty cool in that sense, because tax liability ends up being a big deal. Eats into it. The second or another difference is that if you stick it in the bank, and again, when I meet people that say I have a savings account, I commend them for that, because most people don't have anything. But if you do stick it in the bank, it will never be worth more than what the balance is. So if you're up to $5,000, something happens in life, it won't be worth more than $5,000. Whereas this one, you might have $5,000 in the account, but because it's an illness or something serious, you can tap into the $250,000 of life insurance. And that's a big, big difference there. Like the lady that had $200 in it, but yet was able to take out $75,000. I mean, she didn't go through the whole $75,000 during the treatment, but the nice thing about it is she got to keep it tax-free. Got to keep it because it's in advance on your life insurance, which all life insurance in the U.S. is income tax-free. And so it gives you multiple advantages, if you would. Because I always tell people, look, if you're saving money, that's good in anything. I can't argue with you. I mean, it's good. But then there's good, and then there's better. Does that make sense? And we're talking better. I started the same thing, mutual funds for my kids, and I got tired of it going up and down and up and down. I was like, because the question is this: where will your money be when your child needs the money the most? Right? Where will it be? Nobody knows. Nobody knows. Well, here you will know because we have a guaranteed minimum interest that you'll earn. Minimum that on the worst case scenario, what if the market goes down and stays down forever? Well, we're going to give you 10%, 10% return on your money going back any 5-year period. So nobody can tell you that. Nobody can guarantee you that. Nobody uses the word. And so don't think this is an investment, because if this was an investment, we would be talking what's called a security. Securities are investments. This is, and it means up and down, make money, lose money. This is not an investment. This is a savings plan wrapped around a life insurance policy. You get the best of both worlds. So you'll never hear me say, even though I do have my Series 6 and 63, which allows me, but the reason I have them is because they're so difficult to get. I just don't want to let them go. But I stopped doing that way back when in 2000. I don't know if you remember back in 2001 when the stock market crashed. I always tell people that the quickest way to lose your friends is to lose their money. And that ended up happening to me. My phone was ringing off the hook because people wanted to know where the hell's my money. And I was just like, no, the stock market goes up and it goes down. And that's not a good answer to give people. Here, I can honestly tell you that you will never, ever, you'll go up, but you'll never go down. You'll move forward, but you'll never move back. I mean, and this is my 13th year in this company. I've never had an issue with anybody. And we've had big dips and big drops and everything in between. And that's why on this thing, the name of this program that I'm referring to, it's called Index Universal Life, or IUL. The index means just that. Your savings account, it's just no different than your savings account paying you 1%. Well, what if the bank said, tell you what, we're going to pay you not 1%, we'll guarantee you 1%, but we'll also give you the returns of the S&P 500. So when the S&P 500 goes up, your balance goes up. But it's not in the S&P. But if the S&P goes down, we'll just stick to the 1%. It's not in the S&P. So that's what I was saying. This is not an investment. People call it that sometimes as a generic investment something, but I always call it a savings plan wrapped around a life insurance, because that's really what this is. And so, like I said, there's good and then there's better. This just happens to fall in that category. Multiple benefits with one contribution and tax-free access to your money as well.
Wonderful.
Great question, though. Any other questions, please?
No, I mean, that was the big one and you answered it. So
okay. I mean,
Mondonna, if I just would say one thing is that, so first, when I got this for Johnny, I always thought, okay, so once he's 18, I'm going to, give it over to him. And actually, a couple months before he turned 18, I actually told him about it, told him how it works. And he always knew he had insurance, but I was trying to tell him the intricacies. There are things that you can do, you take some money out, but your real balance grows, and getting into the details. And then he started zoning out. and then when he turned 18, I was like, you know what? I'm going to hold on to it for a few more years, because what I want to make sure is that he never stops paying these $100. And right now it's just still too volatile, right? He's not doesn't know enough about how great this thing is to really make sure that he pays for it, continuously. So I'm going to hold on to it probably until he's 21. And then I'll say, okay, now you're old enough. If you don't want to be responsible, then I guess, lose it, but hopefully I've explained it good enough that he will keep it. And then I also got one, when I got it for him, I got also one for myself. I used to have term life insurance always, because one of the things I always thought is that if I don't manage to build a great business or to save up a lot of money, or to buy expensive art, right? And then something happens to me, I pass away, I still know that there is over $100,000 with my term back then, over $100,000 that somebody's going to get. So it's like, all I have to do is make my little monthly payment, and somebody's going to get this money when I go, right? And then when I got it for him, that was the added thing. Like, I know when, if something happens to me, then Johnny can still go to the school he wants to go to. He can do all these things. And I know this. And it's just by doing this one simple thing. And so for me, this one, because obviously so much better than just a term life, is the really the best money decision that I've, and easiest, without any, there's no hassles, no nothing. And even getting the money out, no hassle. Like he said, you just go on the app, and then I had it within 24 hours actually when I requested money for the college. And I was like, whoa, like that was way quicker than I thought. So that's why I have it. And that's why I decided that now I'm going to share this with everyone. And I didn't know how great it was going to be when I got it, because it was just, a projection. But now having it and seeing how powerful it is, I'm like, everybody needs to know this. And I'm apologizing to my friends that are my age, their kids are older now. I'm like, sorry, I didn't tell you about this years ago, but I'm doing it now. So please forgive me.
Yeah. Oh, that's great.
Like I said, I just fired up my personal one again on my app. I showed you my granddaughters, but this is my personal one. One of the ones that I have, because you can have multiple. You can have as many as you can afford. It doesn't really matter. If somebody does 200 as an adult versus the one doing 400, you just get double of everything. Somebody comes in and does 800. We got people that do 12, 14,000 a month. I mean, it really boils down to what can be afforded. But I wanted to show you, like, this is my premium in October this month already. Oh, damn, they just took it. 400. And then you see the interest of $50 right there, $24 right there, $229 right there, $272 right there, 340. And so that's the magic of compounding interest, that you've got money you're putting in, plus you got the peace of mind of life insurance, plus you got growth on that money, which allows you to really, really take off. And that's why I was saying that it's easy. Now that I got this, you can definitely see the calculator. There's a thing called, and I'll end it with this, what's called the rule of 72. It's one of the most important rules you can look up, because it tells you how often your money will double. And so let's just say, if we use 12%, so we take, let's just say, rule of 72, 72 divided by 12, that's how much interest we're earning a year. That means that every 6 years, your money doubles. Now, that's pretty cool, especially if you have a baby that by 6, barely going into kindergarten or first grade, and their money already doubled one time, like my granddaughter's about to happen. That's pretty cool. And then by the time they're 12, again, by the time they're 18, it doubled 3 times, which is simply incredible. Now this is that. Now, the one we use 8.5% on average, but even so, let's just say, and it's actually been higher because we've been on a bull market since my granddaughter was born. It's been nothing but a bull market. That's all her account has known. But let's just say we take the same principle and do 72, and we divide it by, let's just say, 8%. Well, that's every 9 years. And so that means that for your baby at 9, doubled. At 18, it doubled 2 times. So worst case scenario, it doubles twice. Best case scenario, doubled 3 times. But then we talk about, like you said, how about a savings account? Well, here's a hard one. 72 divided by 1. That's the interest rate. The banks, no, they don't even pay 1%. Let's probably give you 1%. So 72 divided by 1. 1 goes into 72. Well, 72 times. That means that in a savings account, your child will be 72 years old before the money doubled once.
And you have to pay taxes every year on that growth.
Every single year, if you have growth. At 1% fixed, you'll have a growth, but every year. Whereas here, you pay nothing every year. It grows tax deferred, which is a huge deal. And then it comes out tax-free at the end as well. And just so you know, the reason it can do that is because you will be funding it with after-tax dollars out of your paycheck or whoever decides. It's after somebody's been taxed on the money already. So it's really simple. You either pay your taxes in the beginning or you pay it at the end. So if you have a 401k, it's tax deductible now, right? That's the good thing. Right. But when you access it in the future, it's taxed 100% at that point as well. Awesome. Any other questions?
Just the user friendliness. It looks pretty user friendly, but for example, let's say it's my son's birthday. My dad writes a check for him for his birthday. I want to deposit it. And is it easy? Is it like, for example, I'm going to throw Chase again, going into the Chase app, taking an image, depositing, or...
It's even easier than that. You just call the 800 number, give him your policy number, your account number, and you're done. That's all you do it over the phone. You can also, if you wanted to, come in here and just do it online as well. And so as you can see, I just tapped on the payments on my actual app right there for me.
Mm-hmm.
That's the checking account. And if you want, like you said, make additional payments, you just simply tap that button and tell them how much. It could be a one-time thing, or you can increase your monthly one or reduce it.
Mm-hmm.
And so it's really, truly one of those set it and forget it type of things. You do get an annual statement every year in the mail. You also have access 24/7 now. I've been with this company, like I said, 13 years. And 13 years ago, there was no app. 13 years ago, there was none of this stuff. It was wait for your annual statement, right? Or we can, if you really, really want to know, we can pull one up. Call me. Now you can just log in, just like I'm sure. And again, I get the same policy. I get the same. There's no company discount, employee discount, or agent discount. I run the same exact thing is what I get. And so, as you can see there, very simple. So with my granddaughter, I just do it every year. But if I want to throw the account a bone in the middle of the year, here's another 500. It goes anything you put above your indicated amount goes 100% towards the savings portion of the account. Mm-hmm. So right here, I'm doing 1,200 a year, 1,200 a year. Then that takes into consideration what's going towards savings, what's going to what's called the cost of insurance, because there is $300,000 of life insurance, and there's also what's called a policy fee. If I send a dollar more or $100 more, all of that, 100% of that goes only towards the savings portion. No fees, no nothing. But as you can see with this app, that's how simple it is right there. And if I do needed money, they would just simply backflow the money right to the same account that's on file. Most of the time, 24 hours, but I would tell people 48, and they always call me and say, it was quick. So it is pretty user-friendly as well.
Awesome. Wonderful.
And what I'm going to do also, with your permission, I'm going to go ahead and send you a copy of this video.
I was going to ask, because that'll save you time. I'll share this with my husband, and then we'll talk about next steps. Do we sync up with you to set up an account, or? Yeah,
like I said, we'll work in this example. Let me just make sure it's not. I think it took me out full on. We'll work through Sonia just to be safe. And like I said, it's just a matter of asking basic information. And like I said, because your baby's so young, it's automatic approval. There's no medical exam, there's no blood, urine, uses. We do a bunch of stuff for life insurance. None of that would apply to him. Easy. None of that. So perfect. I'll go ahead and send the recording. So if Sonia, if you can text me her email address, that way I can email the certificate, the vacation certificate, and also a copy of the recording. And I'll CC you, Sonia, so you can kind of see what she received. And we'll take it from there. How's that?
Yeah. So Mondonna, just put your email address into the Facebook chat.
If you want to do the okay, yeah.
I can send it on the Zoom chat too.
You can do that as well, and I'll take a picture of it right now. So we can do that. Okay, here it goes. I think you just got it. And let me just snap a quick picture of it, and you will have that momentarily. And Zoom usually takes about 10 minutes, 15 minutes to email me the recording, and we'll take it from there. Okay?
Wonderful. Thank you so much, both of you.
I really appreciate your time. Like I said, pardon my passion for this, but like I said, this is something that I've got on my own little ones as well, and the bigger ones, but in my own life. But what a difference, and I'm so glad that I did what I did, because I always tell people that if I could go back in time, one thing I underestimated is how fast they grow. That's the only thing I missed, and I screwed up because I did not really think that. And so now, like I said, my granddaughter's here, my grandson was here earlier. I'm not going to miss it this time because they grow up so fast. So I wish you nothing but the best, and we'll be hopefully
sign from the universe or something, because I've been sitting on this check from my dad, not knowing what to do with it, and it's perfect timing for this.
There you go. All right. Well, we'll be in touch. You'll have this info here tonight, and I wish you nothing but a wonderful night. Okay.
You too. Thank you so much.
Oh yeah. We'll see you soon. Okay.
Good night. Bye-bye.